Now, do you think the attitude towards annuities, well, is it changing, Jason, and why or why not?
I will say I think the attitude towards annuities are changing. And the reason why that is because when I first got into this industry almost 20 years ago, they were not something that I looked as a viable solution for a lot of people. There was, to that gentleman's point, high commissions. They were very advisor and carrier focused, being the insurance company focused. Where I think the attitude is changing is over the last, I would say, 6 to 7 years, I've started to see more and more annuities coming out that are more client focused and client centric and less advisor and less carrier. And I think that's where the industry needed to go. So I do see the attitude changing. And as a fiduciary, my obligation to my clients is to do what's in their best interest. And I can't put any biases in front of that. So I did have a bias in front of annuities because of how they were first built, but seeing how they are now, I do see them as a viable solution for the right situation, for the right person, for the right goal in mind. You can't throw the baby out with the bathwater. I will say there's some out there that are still really bad and client and advisor focused, and this is where the buyer has to beware. And every advisor should provide you their commission schedule before and as they make the recommendation for that full transparency.
Well, let's go over the pros and cons real quickly. I mean, because when we get into annuities and we start mentioning the word quite a bit, as we've mentioned, with our street reporter, kind of the cockles on the neck, they go up, man. The hairs stand up. People are concerned about it. What are the pros and what are some of the cons?
Let's go into the pros. So you got the guaranteed income, and you could do that through like an income rider, or you could do that through annuitizing the annuity. Of those two, I'm not a big fan of annuitizing it. And if you want to know more, that's where you could reach out. We could talk through it. Another pro is tax-deferred growth. The earnings on the investment with an annuity are not taxed until the annuitant starts to withdraw them. There's no contribution limits. Unlike retirement accounts, there's no limit to how much an individual could actually invest within those annuities. And there's also protection against downside markets. Some annuities offer protection against market volatility, and it could be appealing for someone who's risk averse. Now, here are the negatives, the cons, right? Fees. Annuities have high fees, including surrender charges for early withdrawals and administrative costs. So you got to be aware of those things. You still can make withdrawals. You just have to make sure you're below the withdrawal, the free withdrawal rate. You have a lack of liquidity. What I mean by that is they say, hey, you cannot withdraw more than 7 or 10%. Well, you need to make sure you have other assets to be able to access because they have a lack of liquidity. After a certain period of time, they then say you could withdraw 100% of it, giving you full liquidity, but you gotta have that time horizon when you cannot touch it. Okay. There's limited growth potential. The rate of return of annuities are typically lower than other investments such as stocks or stock mutual funds. And there's also the loss of principal. Some annuities offer a guaranteed return, but others do not. And the annuitant may be risking losing some or all of their principal investments if the market is performing poorly. So this is something that has to be taken into account.
Well, and yeah, you have that conversation. You come in, you meet with Jason Noble and his team, and you see if there is a particular annuity, because there are many, and there might be one that would be a good fit for the portfolio, but that takes a conversation. And again, we're going to open up those spots here in just a little bit. So very important, again, to consider what your financial goals are, and as you're moving towards retirement, maybe, possibly, an annuity might be a good fit. So when it comes to planning for retirement, it's very important to start early. And that seems to be happening more and more today, which is good news. Dave Perkins, again, our man on the street, found someone who seems to be on the right track at a very early age.
Now, you're probably a long ways away from retirement, but do you think about it? Is that kind
Yeah, I mean, of course. I mean, I do have a retirement plan set up, of course.
Do you, are you aggressively contribute to that, or how have you got that set up?
Well, I do $300 a month.
So you're actually thinking about retirement then?
Yeah, I mean, I can't work all my life, and these bones don't hurt that. These don't work.
Do you worry about Social Security being there for you?
Yeah, because they're using Social Security for other needs that's not supposed to be meant for that, so.
All right. So, Jason, just your thoughts. I mean, that's a young person who is ahead of the curve, I would believe. She seems to be doing quite well as far as what she's putting away.
I really like a lot of things that she said. You know, there is more of a pressure for our younger clients to have to save more and be prepared earlier on because of the changes of Social Security that are around the corner. And the conversation I had earlier with one of my clients, he goes, man, I wish they had Roth IRAs when I was younger. Right? They didn't come out until I was later on. Right? And I have clients that are younger, and we're taking advantage of these Roth IRAs and putting them in a really good position for down the road and planning. But you have to start. Right, and what she's doing is $300 a month. If it's $50 a month, you got to start somewhere to be on the track towards your financial goals.